Lee from Fundstrat just made a bold call on CNBC's Closing Bell, saying, "There's a big window for a huge market rebound." And today we're breaking down exactly what he means by that, and more importantly, what it means for you as an investor. In this video, I'm going to show you the full clip of Tom Lee's interview, unfiltered. And then I'll give you my full breakdown and reaction to what he said. We'll cut through the noise, dive into the insights, and break down his outlook for the months ahead. Then stick around, because right after that, I'm revealing two oversold stocks that are quietly setting up for a major comeback. The kind of opportunities smart investors watch closely when the market's in panic mode. So if you only watch one video today, make it this one, all the way to the end. You won't want to miss what's coming. Hit that like button. Let's see if we can get this video to 1,000 likes. Share it with a fellow investor, drop your thoughts in the comments, and of course, subscribe to the channel so you never miss out on the next big financial insight. Alright, let's get into it. Here's what Tom Lee had to say.
Where are we going?
Well, I think a couple of things that we're thinking about is we know markets have gotten very pessimistic. They've priced in a 60% probability of a recession. And if tariff negotiations de-escalate, then the probability isn't that high. So I think that there's still a big window for markets to have a large rebound, but it's really the path of this de-escalation.
Are we in a bear market? I mean, we're in a bear market, right? I mean, it almost doesn't matter, textbook, whether you say we are or not. It's like so many stocks got just absolutely destroyed before this uncertainty happened in the market.
Yes. I mean, if we define a bear market as stocks feel like a grind or you're losing money, I'd say it really started in December because markets were churning even through the February high. But if I was to define a bear market as unleashing a type of financial tightening that leads to a recession, we're not at that criteria yet. But I think it feels like a bear market for the average person.
Are we supposed to buy into that or just stay cautious and on the sidelines, don't do anything, sit on our hands? I don't think people know what to do. And I'm not just talking in the CEO suites because they obviously don't know what to do. How can you? So what is the investor supposed to do?
Yeah, I mean, I think there's sort of two brains people are fighting. One is the tactical brain, which is, look, they want to know if this is a bottom, and they want to be convinced of it by seeing stocks rally on bad news. But if someone had the investor hat on, and that's the long-term brain, I have a lot of confidence the U.S. companies are going to navigate through this treachery. Stocks are hugely oversold because you never really lose money buying the VIX at 50. Or when the percentage of stocks above the 200-day drops to 15, those are almost guarantees of positive 1-year, 3-year, 5-year returns. So it depends which brain you're wearing today, but I'd say the majority of our clients are trying to be tactical.
I hear views of, well, it's really hard to get uber bearish now because a headline at any moment, as I said in the open here, the market is waiting so hard for some bit of good news that if you're on the wrong side of that, you get a day like you had on Wednesday.
Yes. I mean, if I was to oversimplify the framing of this, U.S. and China have absurd levels of reciprocal tariffs at the moment. And if you believe those are in place, then the global economy is in trouble and you should be bearish. But if this is a matter of who makes the overture first or blinks, but we know it de-escalates, then I think the downside it comes off dramatically, and I think stocks can actually do really well into the rest of the year.
So you'd be a buyer right now?
Yes, and with the apology that, of course, I didn't think Liberation Day was going to be this draconian, but yes, I would be buying stocks today.
What would you buy?
Well, one of the things we did for our clients last night is to look at what's called Walter Deemer calls sold out stocks, which is worse than oversold. Sold out stocks don't go down because there's a lot of bad news priced in. Mm-hmm. There's a lot of stocks that didn't make new lows on Tuesday, April 8th. They made their lows a month ago, and they had lower volume on April 8th. Those are what I'd call washed out stocks. A group that I think is washed out is the Mag 7. So I'd look at Mag 7 as a place to really expect a rebound, including stocks like Tesla.
Okay. You used the word draconian. That was your word. But I'm going to play off of that and say, well, what if we're in a post-draconian period where, because of that, we're left with the rubble of that decision-making in the White House? And the damage has been done. CEOs have no visibility whatsoever. Do you see this consumer sentiment number today?
Yeah, they're awful.
Do you see where inflation expectations are?
Yeah, they've gone bananas.
Do you see what earnings expectations have done recently?
I mean, there's no ability to make guidance.
So what if the damage is already done now?
That's right. Now, we have to keep in mind this has been 10 days. So it is a shock, a high amplitude shock, but only of 7 days. So someone can restart the patient's heartbeat. I think that the White House is now keenly aware that Main Street can't handle a huge deleveraging because it is going to lead to job loss, and he's listening to CEOs. So I think there's a really big window to repair the bulk of this damage. And at the other side of this, of course, is that we have reciprocal tariffs in place that are acceptable. We have tax policy that's changing and less regulation. So I actually think the 2026 outlook is still quite good.
Which puts are you, so to speak, more reliant on now, a Fed one or a Trump one?
Well, I think there's a call at work and a couple of puts. I think that there is a Fed liquidity put that was in evidence today by the Fed.
When Collins said what she did?
Exactly. And we know the Fed put on rates strikes much lower. The White House has a policy put because we know that you can't brinksmanship the global economy to a halt just to try to get China to blink. And I think that the call is, I think there's a negotiator call, which means I think the White House exercised the Navarro call and replaced him with Besson.
So, let's break it all down. He's still optimistic about where the market could head from here. Now here's what he's really saying. The market has gotten extremely pessimistic. According to Lee, investors have priced in about a 60% chance of a recession. That's heavy. But he points out that this is mostly driven by uncertainty, especially around tariffs and geopolitical tensions. If those tensions de-escalate, especially between the US and China, then a lot of that priced-in risk could unwind fast, and that opens the door to a major rebound in the market. One of the big takeaways is how he frames the current environment. Are we technically in a bear market? Depends on how you define it. If you're going by textbook definitions, maybe not. But if you define a bear market based on how it feels, with stocks grinding down, portfolios shrinking, and sentiment crashing, then yes, this feels like one. And that's the reality for most everyday investors right now. So what should you do as an investor? This is where it gets really interesting. Tom Lee talks about the two types of mindsets investors are battling with, the tactical brain and the investor brain. The tactical brain wants to see confirmation, wants to see stocks bounce on bad news, and needs evidence that we've hit bottom. The investor brain, though, is thinking long-term. It's the part of you that remembers how resilient U.S. companies are and how historically, when the VIX hits 50 or the percentage of stocks above their 200-day moving average drops below 15%, it has been a reliable signal for long-term gains. According to Lee, those are the kinds of setups that tend to lead to solid 1-year, 3-year, even 5-year returns. But most of his clients, as he puts it, are stuck in tactical mode right now, trying to time the bottom instead of thinking long game. Then he pivots to a big insight. The market is desperate for good news. Just one positive headline, say, around trade talks or policy, could send stocks soaring. That's why it's hard to be super bearish right now. If you're on the wrong side of that sentiment snapback, you get caught in a big rally, like what happened the previous Wednesday. He simplifies the situation between the US and China by calling it what it is, absurd. Reciprocal tariffs at this level are unsustainable. And that binary setup, whether these tariffs de-escalate or stay in place, is the key. If things calm down, he believes the downside risk vanishes significantly and stocks could do really well for the rest of the year. Then he says something clear. He's a buyer right now. Despite the earlier misfire, he's not backing away. He's actually doubling down. He even gives us a specific strategy. His team looked into sold-out stocks, not just oversold but sold out. These are names that didn't hit new lows on April 8th, had lower volume, and basically had all the bad news priced in already. These are what he calls washed-out stocks. And guess what? He believes some of the Mag 7 stocks fall into that category. That includes big tech names, even Tesla, which he specifically mentions. These are the areas he thinks could rebound hard. But then comes the concern. What if we're in a post-draconian period? In other words, what if the damage has already been done? Corporate decision-making has been paralyzed. CEOs are flying blind. Consumer sentiment has cratered. Inflation expectations are soaring. Earnings guidance is a mess. So is it too late? Lee acknowledges the shock is real, but it's still early. According to him, we've only been in this state for about 10 days. That means there's still time to restart the heartbeat, as he puts it. He believes the White House is starting to understand that a massive deleveraging could hurt Main Street, lead to job losses, and trigger real economic pain, and that pressure might force more constructive policy moves. He also touches on what he sees looking out into 2026, and surprisingly, he's still bullish long-term. He expects a world where tariffs are manageable, tax policy is more favorable, and regulations are relaxed. So the long-term story in his view still looks solid. Then we get into the fun part. Puts and calls, metaphorically speaking. He says there are multiple forces at play right now. One is the Fed put, which is basically the idea that the Fed will step in to provide liquidity or rate relief if things get too bad. That's already showing, especially with recent comments from the Fed's Susan Collins, which signaled potential support. Then there's the White House policy put, the idea that policymakers can't let the global economy implode just to play hardball with China. And finally, he mentions what he calls a negotiator call, implying that someone, maybe within the administration, will blink and de-escalate the trade tensions. So what does all this mean for us as investors? Tom Lee is saying, yes, it's rough out there, yes, sentiment is crushed, but this could also be a generational opportunity to get in while prices are low. If you're thinking long-term and you believe in the resilience of American companies, this could be your window. He's not ignoring the risks, but he's betting that cooler heads will prevail, and when they do, the market will bounce back fast. Let me know what you think in the comments. Do you agree with Tom Lee? Are you buying this dip, or sitting on the sidelines waiting for more clarity? As always, if you got value from this breakdown, don't forget to like, subscribe, and hit the bell so you don't miss more content like this. Now let's dive into the 2 oversold stocks set for a major comeback. Stocks that are not just undervalued but are poised for explosive growth. These aren't just any companies, folks. These are hidden gems that the market has overlooked, but not for long. These are companies that are at the forefront of innovation and industry leadership, paving the way for the future. First up, we're diving into the world of high-performance computing with AMD, ticker symbol AMD. This company has been a cornerstone of innovation in the tech industry, consistently pushing the boundaries of what's possible in computing. From their humble beginnings to becoming a global leader, AMD's journey is nothing short of remarkable. Now, if you're even remotely familiar with the tech world, you know AMD. They've become a household name, synonymous with cutting-edge technology and high-performance computing solutions. They're the driving force behind some of the most powerful CPUs and GPUs on the planet, delivering performance that powers innovation across industries. From gaming PCs that deliver immersive experiences to data centers that handle massive workloads, and even the latest game consoles that redefine entertainment, AMD is at the heart of it all. But here's the thing. AMD has taken a bit of a hit lately. Their stock has seen a decline, and it's got some investors feeling uneasy. The stock is down, and some investors are getting nervous. It's understandable. Market volatility can be unsettling. But let me tell you something, folks. This is not the time to panic. In fact, it's quite the opposite. This is the time to get excited. Why? Because moments like these often present the best opportunities for savvy investors. This dip, it's not just a setback. It's your golden opportunity to invest in a company with a proven track record and a bright future. See, AMD is fundamentally a strong company. Their foundation is built on innovation, quality, and a relentless drive to lead the industry. They're sitting on a treasure trove of cutting-edge technology, from advanced semiconductor designs to revolutionary chip architectures. And their products, they're in higher demand than ever, as industries across the board rely on AMD to power their operations. So why the dip? Well, a lot of it has to do with the overall market sentiment. It's not just AMD, many companies are feeling the pressure. Trump tariffs, inflation worries, interest rate hikes, and geopolitical uncertainty are creating a challenging environment for the market as a whole. These factors are weighing on stocks across the board, and AMD is no exception. But here's the key. These are short-term headwinds. The underlying demand for AMD's products isn't going anywhere. If anything, it's only growing stronger. High-performance computing is becoming the backbone of modern technology, and AMD is perfectly positioned to lead the charge. Think about it. Cloud computing, artificial intelligence, machine learning, the metaverse, these aren't just buzzwords, they're the future. And all of these megatrends are fueled by the kind of powerful chips that AMD produces. Their technology is the engine driving these innovations. AMD's chips are not just powering devices, they're enabling entire industries to evolve and thrive. And let's not forget about the gaming industry. It's bigger than ever, with no signs of slowing down. AMD is a major player here. Their latest generation of GPUs is setting new benchmarks, delivering performance that gamers and developers alike are raving about. With a market cap sitting at roughly $153.5 billion, AMD has established itself as a major player in the semiconductor space. In 2024, the company pulled in $25.79 billion in revenue and posted a net income of $1.64 billion. That gives it an earnings per share of $1.02 and a price-to-earnings ratio of 92.65, which is high, yes, but it reflects the kind of growth investors are still expecting from AMD, especially with continued momentum in AI, gaming, and data center chips. It's a classic case of a high-growth tech stock temporarily beaten down, but with serious long-term potential. Their current stock price of $94.50 is 101.26% below the fair value price of $190.19. Now I know what you're thinking. Okay, you've convinced me. AMD is a solid company with a bright future. But what about the competition? And you're right, the semiconductor industry is fiercely competitive. But AMD has a few key advantages that set them apart. First, their products offer an incredible price-to-performance ratio. They deliver top-tier performance at a price point that's hard to beat. This makes AMD a favorite among gamers, professionals, and businesses alike. Second, AMD has a strong track record of innovation. They're not just keeping up with the competition, they're setting the pace. Their commitment to research and development ensures they stay ahead of the curve, consistently delivering groundbreaking products. And third, AMD has a diversified customer base. They're not overly reliant on any single market or customer, which gives them resilience. From gaming to data centers to AI applications, AMD's reach is vast and varied. So, to sum it up, AMD is a fundamentally strong company with a bright future. They're well positioned to capitalize on the growing demand for high-performance computing. And with their innovative products, competitive pricing, and diversified customer base, they have a real edge in the market. This recent dip in their stock price is a golden opportunity for savvy investors to buy into a world-class company at a discount. So, if you're looking for a company that's poised for a power surge, AMD might just be the one. The future is bright, and AMD is ready to lead the way. Now let's talk about a company that needs no introduction, PayPal. Ticker symbol PYPL. Founded in 1998, PayPal has grown from a small startup to a global powerhouse in the digital payments industry. It's a name synonymous with trust, innovation, and convenience in the world of online transactions. This is a company that revolutionized the way we think about money. Before PayPal, sending money online was cumbersome and often unsafe. PayPal changed all that by creating a secure, user-friendly platform that made digital payments accessible to everyone. They were at the forefront of the digital payments revolution, and they've built an empire connecting merchants and consumers all over the globe. Today, PayPal operates in over 200 markets, supporting transactions in more than 25 currencies, making it a truly global player. But even titans can stumble, and PayPal has faced its share of challenges recently. The company's stock has seen a significant decline, and some critics argue that its best days are behind it. The stock has been hammered, and some investors are questioning whether PayPal has lost its touch. Concerns about slowing growth, increased competition, and market saturation have weighed heavily on investor sentiment. But let me tell you something, folks. Rumors of PayPal's demise have been greatly exaggerated. This is a company with a proven track record of resilience and adaptability. In fact, I believe PayPal is significantly undervalued right now, and here's why. The market often overreacts to short-term challenges, creating opportunities for savvy investors to capitalize on long-term potential. First, let's address the elephant in the room. The slowdown in e-commerce growth. Yes, the pandemic-driven surge in online shopping has cooled off, but that doesn't mean the e-commerce story is over. After the pandemic boom, online shopping has cooled off a bit, and that's impacted PayPal's growth rate. However, this is a natural part of the market's evolution. But here's the thing. E-commerce is not going away, it's simply maturing. Analysts predict that global e-commerce sales will continue to grow steadily in the coming years, and PayPal is well positioned to benefit from this trend. And as it matures, guess who remains the dominant force in digital payments? That's right, PayPal. Their brand is synonymous with trust and reliability, which is crucial in the financial services industry. They have a massive global network, a trusted brand, and a suite of products and services that are unmatched in the industry. From small businesses to large enterprises, PayPal is the go-to platform for digital transactions. They're not just a payment processor anymore. PayPal has evolved into a comprehensive financial ecosystem. They're a comprehensive financial platform, offering everything from buy now, pay later options to cryptocurrency trading to international money transfers. These services cater to a wide range of customer needs, ensuring PayPal remains relevant in a rapidly changing market. And let's not forget about Venmo, PayPal's peer-to-peer payment app, which has become a cultural phenomenon, especially among younger generations. Venmo has redefined how people split bills, share expenses, and even pay for services. Venmo is a cash cow for PayPal, generating billions of dollars in revenue and growing at a rapid pace. Its social payment features have made it a favorite among millennials and Gen Z. Now I know what you're thinking, but John, what about the competition? With so many new players entering the fintech space, how does PayPal stay ahead? There are so many new payment apps popping up every day. From Apple Pay to Square, the competition is fierce. And you're right, the fintech space is getting crowded. But competition isn't necessarily a bad thing. It pushes companies to innovate and improve. But here's the thing, PayPal is playing chess, not checkers. They have a long-term strategy that goes beyond just competing on price or features. They're not afraid to acquire promising startups, invest in new technologies, and adapt to the changing landscape. This forward-thinking approach has allowed them to stay ahead of the curve. They're constantly innovating, adding new features, and expanding into new markets. Whether it's through partnerships, acquisitions, or in-house development, PayPal is always looking for ways to grow. They're not resting on their laurels, and they're not going down without a fight. PayPal has faced challenges before, and they've always come out stronger on the other side. PayPal currently holds a market cap of $61.6 billion, which is significantly lower than where it was trading just a few years ago. In 2024, the company reported $31.8 billion in revenue, with a solid net income of $4.15 billion. Its earnings per share came in at $4.03, and it's currently trading at a PE ratio of just 15.45. That's relatively cheap for a fintech giant with strong earnings power and a massive user base. Their current stock price of $62.27 is 99.21% below the fair value price of $124.05. For value-focused investors, this kind of valuation might be hard to ignore. So, to sum it up, PayPal is a dominant force in the world of digital payments, with a massive network, a trusted brand, and a suite of products and services that are unmatched in the industry. Their ability to adapt and innovate ensures they remain a leader in the space. They're well-positioned to capitalize on the continued growth of e-commerce, the rise of mobile payments, and the increasing adoption of digital financial services. The future of digital payments is bright, and PayPal is leading the charge. This recent dip in their stock price is a fantastic opportunity for investors to buy into a blue-chip company at a bargain price. PayPal's story is far from over, and the best chapters may still be ahead. There you have it, folks. Two powerhouse companies, both oversold and ready to roar back stronger than ever. Remember, these are just two of the many exciting opportunities out there in the stock market waiting to be explored. If you're serious about finding winning stocks in seconds to skyrocket your portfolio, use Forecaster, the ultimate tool for uncovering high-value investments and making informed decisions. Try it for free today. Just click the link in the description with my code Galore10 for an exclusive 10% discount on your subscription. And hey, if you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides to boost your knowledge, join the Stocks Galore Patreon today and take your investing game to the next level with our expert insights. Our members there get full in-depth analysis on most of these stocks I mention here, plus exclusive updates. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors today. Link is in the description, don't miss it. As always, thanks for watching and supporting the channel. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel for more content. Until next time, happy investing and stay informed.